All right, let's talk about one of the most punishing and, frankly, most important parts of the tax code for any of us in the business, Section 1245. If you deal with depreciated business assets, you've got to know this inside and out. This is the government's statutory clawback, and believe me, it has some serious teeth.
So why does this rule even exist? Well, this quote right here tells you everything. You see, before Section 1245, there was this brilliant little trick. A business could buy equipment, take all these juicy depreciation deductions against its high-tax ordinary income, and then turn around and sell that equipment for a gain that was taxed at those lovely low capital gains rates. It was a classic case of having your cake and eating it too. Section 1245 was put in place for one reason and one reason only: to shut that game down.
Okay, so here's our game plan for deconstructing this thing. First, we're going to talk about just how powerful this rule is. Then, we'll nail down exactly what kind of property gets caught in its net. After that, we'll get into the math of how it works. Then we'll hit the most dangerous part, the installment sale crisis. And finally, we'll look at the very few, very narrow ways to get out of it.
All right, let's kick things off with where Section 1445 gets its muscle. It all comes down to a single, very powerful phrase in the law that basically lets it be king of the hill. Here it is, the magic words, notwithstanding any other provision. You should think of this as the ultimate trump card in the tax code. It means that when Section 1245 walks into the room, most of those other rules you rely on for tax-free treatment, well, they have to sit down and be quiet. They just get thrown right out the window.
And look at what it steamrolls. We're talking about the absolute cornerstones of tax planning. That tax-free incorporation under Section 351? Nope, 1245 can force gain. That partnership contribution under 721? Same deal. Corporate liquidations, even some like-kind exchanges? Section 1245 can barge in and demand its pound of flesh, making sure the government gets its tax clawback.
Okay, so we know this rule is a beast, but what exactly does it hunt? You have to know what kind of assets we're talking about, what's actually in the trap. So you've got two main buckets here. Section 1245 is for personal property, think machines, company cars, equipment, even some intangibles. And here's the kicker. When you sell it, all of the depreciation you've ever taken can be recaptured as ordinary income. Then you've got Section 1250, which is for real property, buildings, and its rules are, well, a lot nicer. It usually only recaptures the depreciation you took that was more than the straight line amount. A huge difference. And this is a huge but. This is where the real trap lies. There's property that walks like a duck and talks like a duck. It looks and feels like real estate, but the tax code says, nope, that's Section 1245 property. We're talking about things like special farm buildings or certain storage facilities. So you think you're selling a building under the gentler Section 1250 rules, but surprise, the IRS treats it like a piece of machinery and you get hit with that full, harsh recapture. That's a nasty surprise you do not want. All right, let's get into the nitty-gritty. How does this trap actually work? It all comes down to one key concept, one number, called Recomputed Basis. This is the engine that drives the whole thing. So what is this Recomputed Basis thing? It's actually pretty simple. You just take the property's adjusted basis and add back all the depreciation you've taken. But look at that last part, allowed or allowable. That's the stinger. It means even if you messed up and forgot to take a depreciation deduction one year, too bad. The IRS says you should have, so it gets added back anyway. No excuses. Ouch. The math itself is easy peasy. You just take your adjusted basis, what the asset is still worth on your books, and you add back every single dollar of depreciation you ever took on it. Boom. That's your recomputed basis. That number sets the ceiling for your potential recapture. Now for the final step. How much of your gain is going to get hit with those high ordinary income rates? Well, the rule is pretty logical. You look at two numbers, your recomputed basis that we just figured out, or the amount you sold it for. You take whichever one is lower. Then you subtract your adjusted basis from that number, and there you have it. That's the amount of gain that gets recharacterized from capital to ordinary. Okay, everything we've talked about is important, but this is where things can go from being a tax headache to a full-blown financial crisis. We are talking about the installment sale. Normally, installment sales are great, right? You recognize the gain and pay the tax as you get the cash. Makes perfect sense. But here comes Section 453I to crash the party. It says flat out that all that recapture income we've been talking about, you have to recognize all of it in the year you sell, immediately. It doesn't matter if you only got a tiny down payment. The tax on the entire recapture amount is due now. Let's put some numbers to this to see just how bad it can get. Let's imagine Fabricator Inc. sells a big machine for $1 million. Now, this machine has been fully depreciated, so its adjusted basis is 0, and let's say they took $500,000 in depreciation on it over the years. The deal is structured as an installment sale. So in year 1, Fabricator Inc. gets $100,000 in cash as a down payment, just 10%. The other $900,000 is coming in future payments. So far, so good, right? Wrong, because here comes that brutal rule from Section 453I. Even though they only have $100,000 in their pocket, the law says they have to recognize the entire recapture portion of the gain right away. In this case, that's the full $500,000. They have to report $500,000 in ordinary income. And you can see exactly where this is heading. Let's assume a 37% ordinary income tax rate. The tax on that $500,000 phantom gain is a staggering $185,000. And there it is, the trap in its purest, most painful form. The company has a tax bill for $185,000, but they only took in $100,000 in cash from the sale. They are $85,000 in the hole. They have to find that cash somewhere else in the business just to pay the tax. It's an absolute liquidity nightmare, created entirely by this rule.
Okay, that was pretty brutal. So the big question is, are there any escape hatches, any ways around this? Well, yes, but they are very, very specific. These are not loopholes. They're specific statutory relief valves.
The two biggest escape routes are for gifts and for transfers of death, and they are completely different. Think of the recapture potential as a hot potato. If you gift the asset, you don't get burned. No tax for you. But you've just handed that hot potato to the recipient. They get your low basis and your entire depreciation history. We call it a carryover taint. Now, a transfer at death, that's the magic trick. Under Section 1014, the basis gets stepped up to fair market value and poof, the hot potato just vanishes. The recapture taint is permanently erased. It's gone forever. And you can see this hot potato idea plays out in other tax-free transactions too. When you contribute property to a corporation under Section 351 or to a partnership under 721, it's a lot like a gift. You generally don't trigger the tax rate then, but you're not getting rid of the problem. You were just passing that recapture potential, that taint, right along to the new company. The problem is just deferred, not eliminated. So let's just boil this all down. What's the bottom line? First, Section 124.5 is not a new tax. It's a character and a timing rule. It's simply the government's way of saying, hey, you got a tax break against ordinary income when you took depreciation, so when you sell it, we're clawing back that benefit at ordinary rates. It's all about symmetry. But the real, clear, and present danger is that liquidity trap. That's the part that can absolutely crush a business if you're not ready for it. So I'll leave you with this to think about. Now that you've seen the mechanics of this trap up close, how does it change the way you look at your clients' fixed asset lists? How will this change the conversations you have around selling the business, or even just a major piece of equipment? Because when it comes to Section 120.45, proactive planning isn't just a good idea, it is the only defense.